I'm Sue Curlett, your co-host today. We're missing out on John Smith. He's got a crisis underway. He's putting out some fires. But we are joined today by Kevin Murphy with Freedmont Mortgage. And so, Kevin, I just wanted to let you introduce yourself, tell everybody a little bit about yourself, how long you've been in the business.
Absolutely. So again, it's Kevin Murphy with Freedmont Mortgage. I am now 31 years in the business, all with the same company. Pretty crazy,
Wow,
right?
that is insane. Yeah, like I don't know anybody else that stayed with the same company for 31 years in this industry. We usually change here and there, you know what I mean? Some companies offer stuff, but it's a good sign that Freedmont's a solid org. You're always up to something, and I love that. You know what I mean? I enjoy social media because of people like Kevin Murphy. And one of the things that I can share with you is years ago. Now we're going back probably 10 years, somewhere in there. I had a house that my buyer was purchasing. I believe I had the buyer on this side. And the homeowner's insurance would not allow us to have a policy because there was a few dead trees on the lot. Now, it was the first time that I had run
Oh,
into
wow.
the insurance being declined because of dead trees. The seller, I did have the buyer because the seller was like, I'm not doing it. I'm not paying somebody thousands of dollars to come out here and take these trees down. They can find other coverage. So long story short, me being the generous person that I am and not the smartest. Okay. So like, I will admit this was a dumb move on my part. I told the seller, personally, I will come remove the wood if you have the trees down and cut up. So I said to my husband, can I do this?
It
Right.
was a lot of wood.
Well, oh my God, Kevin, it was like 8 truckloads, including trailers. And not only that, my husband didn't talk to me. I swear to God, he didn't talk to me for like a week because they cut them into like 18-inch logs, but not split. You know what I mean? So we had to roll these things. We ended up using some of them as seats for the fire
Right.
pit. You know what I mean? Like things like that. But we had wood for a good 2 or 3 years. I mean, I can't even tell you how many cords of wood we had. And he went out and had to buy a splitter. I mean, it was like he said, Susan, never again. And I was like, okay, I swear never again. I won't do that one again. Um, but this is the kind of stuff that happens in our life. I'm like,
Uh,
no is not an option for me. Like, how is more the answer, the question. Like, how am I going to get this through? How am I going to do this? And lenders are super important, but at the same time, you know, it doesn't matter who you are as a lender. You can only move forward if there's homeowners insurance. So all of us have, you know, all these I's to dot and T's to cross. And sometimes these things pop up at the appraisal, pop up, you know what I mean, with the insurance company. So don't wait, right? I mean, don't wait to the last
Absolutely.
minute to get this stuff put into place. Do you find that the homeowners insurance company
Have
always
you
goes out and
have
looks
you
at the
heard any?
property?
I was told something by an agent recently that they had two clients that had already closed on houses in this past year, and their insurance companies sent, according to them, a drone to take a look at the roof for each of those houses and want those
Yep.
roofs replaced after they've already bought their house, after they already had a home inspection. Have you run into
Yeah.
this?
I've run into 15 years. Like they want the roof to be less than 15 years old. And if there's not confirmation, then they want the roof certified at least. So, I mean, we run into situations where roofs are 50-year shingles. So, you know, we're seeing more and more from these homeowners insurance companies that are really underwriting and looking at these files pretty hard. So, you know, something to keep in mind, guys, is don't wait till the last minute to shop your homeowners insurance. If they're going to go out and they're not going to give you a binder without seeing the property, you may be in a situation where you have to extend. It's really important to understand the significance of extending your closing. So, if you don't mind, Kevin, tell us a little bit about the lock, and what happens if that lock has to be extended and things like that when people lock into a better rate.
Right. So one of the major things is you're locked for a certain amount of time, whether we do a 30-day or 45-day, whatever we agree to when we start the loan process, and you ask us to lock the rate, we're locked in for that amount of time. Anything beyond that amount of time, we're going to request an extension, and that's going to cost money. We have to extend the rates. If it's the
Absolutely.
buyer's fault, they're going to definitely have to pay for the extension. Could cost a half a point, if it's a 30-day
Right.
extension. If it's the seller's fault, and let's say they didn't do the repairs to do, we can ask the seller to pay for it, negotiate it that way. But it really depends on, if they're going to be willing to do it or not. They might not be willing to do it.
I ran into in the last 2 years, two deals in the last 2 years where we needed extensions and the deals fell through because of the extension. There's buyers out there that are doing backup offers. And what that means basically is that this person's coming in saying, hey, I want your house too. And I'm going to wait. And if something happens, call me. In the first situation, it got a little bit shaky. The lender couldn't get them qualified. They had to add a co-borrower. And in doing so, we needed to underwrite that co-borrower. And it was a 2-week extension. And they came back and said, no, we're going to go with another offer. And that buyer lost everything. I mean, they lost their earnest money. Well, they didn't lose their earnest money deposit, but they did lose their inspection money.
The home inspection,
And the seller wanted to keep the
right?
earnest money. Yeah. So you got to be
Right,
careful.
for
You got to
sure.
know what you're doing,
Right.
get with a quality lender. What are your thoughts on that?
And that's a big thing to get pre. You definitely should get pre-approved up front, and that means when you're talking about pre-approval versus pre-qualification. A pre-qualification is pretty simple. You give the loan officer information verbally. We pull a copy of your credit report. We run it through desktop underwriter, get an approval, and we're basically saying that you're okay to go shop for a house based on what you told us verbally. But I have seen so
Right.
many times where somebody tells us the wrong income, and they're already at the ceiling of their debt to income ratio. They're at the maximum of their debt to income ratio, and they made a mistake about their income, and then we go to verify it, and it's a problem. So really, up front, you want to provide your W-2s, your pay stubs, if you're self-employed, your tax returns. Get everything to your loan officer up front, so everything can be I's dotted, T's crossed, the math works. So you're shopping in the right price range. You're not, you know, underqualified for what you're looking at, and you're not going to run any problems when you go under contract, because you don't want to lose like you said, your EMD. They could keep your
Every
EMD if they wanted to, depending on what the circumstances are. There's a lot of offers
Absolutely.
written out there right now. They're waiving financing because they're trying to get their accepted, but also the home inspections and the appraisal fees, that sort of thing. So you can put some money out of pocket, save yourself that money if you do things the right way up front, and provide your lender, your loan officer, with the information that they're going to need up front instead of waiting till the end.
100%. I'm so with you. I think that for everybody involved, it might seem like you put your foot on the gas and you just push, right? But the problem is when you do that without making sure that all your ducks are lined up, then you end up in these scenarios where nobody can help you. I mean, there's too many things that come into play, and every day the struggles are real. So whether it's your realtor, whether it's your lender, whether it's your title officer, everybody's got their own little list of issues that could arise. And you need to be in a trusted network of people that are going to work with you to make sure that the process is simple. When you go, and there's nothing wrong with going with your own family, friends, lenders, title officers. We don't make a dime off of the lender. It's illegal to do that. So one of the reasons that we prefer our chosen lenders is because we know their experience. We know, I mean, Kevin Murphy has been doing this for 31 years. There's a lot to say about that. Every situation, every deal is different. And so, especially as realtors, we never do the same house twice. It's never that simple. There's always some kind of piece of the puzzle that has to fit perfectly, or, and nothing fits. So keep in mind when you're talking to a lender that experience does matter. Making sure that lender's qualified, making sure that lender is ready to help you dodge whatever bullets are going to come your way. The insurance company being just one of them, one of the many aspects that we're constantly looking at.
Uh,
I'm sorry, Kevin, go ahead.
And you're better off oversharing your information. As a buyer, you're better off oversharing your information with the lender. If we ask you a question like, have you made any large purchases in the past 90 days? Have you opened any
Yeah.
new credits? And you tell us no, and then we find out later you co-signed for your cousin.
Yeah.
You did open new credit. Maybe it's not yours.
Yours. Yeah.
Now you're responsible for it. Payments in your debt ratio. So
Yeah.
overshare. If you've opened with anyone, let your lender know exactly what's happened in your life in the past several months, so there aren't any surprises at the end of the puzzle.
And something that we run into often, right, is parents, especially now that I'm at that age, parents co-signing for student loans. I mean, that student loan then is on the parents' credit as well. So you're probably thinking, oh, well, I don't have any student loans, but if you co-sign for your kids, you do. And those numbers are held against you as well, right? There's no way around that. So when you're buying a house, you have to take all those things into consideration. Am I wrong?
Absolutely, especially when they're still in school and the child, there's no way they're making the payments yet. I mean, if they're
Yeah,
making the payments, you can prove they're making the payments over 12 months or
got it.
so, then you might be able to remove that account from the debt ratio. But you got to be able to prove that the child has been making those payments for X amount of time. Just like a co-signed car would be the similar situation. You have
Yeah.
to prove with canceled checks, some documentation that somebody else is actually making those payments. You're not responsible for.
We shared this on another podcast one time, but a lady had co-signed for her son to buy a house, and she never thought another thing of it. And then she went to sell her house, and her son had never made a single payment. The IRS, the government, the attorneys that were involved took all of her money, all 200 and some $1,000. Now, what she ended up with, I don't know, because I was on the buy side and that was the seller. But she had to pay all of his late payments. She had to pay all the attorney fees. She had to pay her back taxes. I mean, there was just all kinds of stuff against this poor woman. And, so when you're selling, make sure also that you're working with somebody, an accountant, somebody that can help you understand the process of selling your house. Talk to the lender. The seller can also talk to the lender and say, hey, what do you need from me? It's super important that everybody's involved in the transaction and everybody knows. One of the things that we were talking about is also 401k money. That's your money and you can borrow against it, right? For your down payment or your closing cost or, whatever you may
Absolutely,
need. And how many
absolutely. I
how
think
many
it's one
people
of
would you
the best
say
ways.
how many people would you say actually use that 401k money? Like half or 25%?
Right now, we have a very large. I would say half right now are using their 401k for their down payment and closing costs, especially where they're in a situation where they're going to sell their current home later and buy now.
Right.
So they're going to buy now, sell later. They need the money. Where's the money going to come from for down payment and closing costs? Got to come from somewhere. So if they don't
Yeah.
have enough money saved up in their checking, that type of thing, then they use their 401k, borrow against it,
Right.
and then when they sell their current home, they pay themselves back pretty quickly. So, they probably sell within 30 to 60 days. You just put the money back into your own account because you're borrowing, like you said, borrowing from yourself, which is the best way to do it, I think.
I think so too. I mean, I think that it's a scary thing for some people because that's your retirement money. And you're like, I'm not touching my 401k. We can go bankrupt before I'm touching my 401k. But this is one of those situations where there's no penalty for you to borrow your own money as long as it's going toward purchasing a home. That's correct, right? There's no penalty unless you don't repay it, then you have to pay. But
Right. But,
as long as
so,
it's a loan.
right. So, difference if you're borrowing versus two completely different things. So, a 401k you can borrow against and pay yourself back. An IRA, I don't believe you can do that. You'd have to cash that in. In that case, you're going to pay taxes and penalties on an IRA. Definitely
Right.
talk to your accountant before you do either one, just to make sure. It should be on a 401k that you can borrow against it and pay it back and not pay anything except the interest that you agree to pay back to yourself, basically.
Yeah. So how long is a pre-approval good for? I had somebody ask me this the other day, and I thought it was really kind of a basic
So,
question that we should answer.
so the credit report itself is the main piece of that puzzle, one of the main pieces anyway, and that's
Okay.
good for 120 days. So once
Okay.
we pull a full credit report, we don't have to pull again for 120 days. So if you
Okay.
close within that time period, your credit report's good for the whole time. And during that process, we would just have to update your pay stubs and your bank statements, that sort of thing, because they're only good for 30 days. So you have to update those as we go forward. But the credit report itself is good for 120 days. So as long as you don't change jobs, buy a new car, any
Right.
major changes, then you're pretty much good for the 120 days.
And does Freedmont, like, I know a lot of mortgage companies pull credit like right before closing. Does Freedmont do that as well? Or, is that just a general finding that a lot of companies will pull your credit just to confirm that you haven't got any more purchases on there right before closing? Or is that not a common?
Can you repeat?
Yeah. So a lot of
You broke
times
up. Can you repeat?
yeah, yeah. A lot of times people will have their credit pulled right before closing, like the lender will pull it just to make sure that nothing's changed, just to make sure that there's nothing on there. So for our listeners, it's really super important that they understand, in my opinion, that they don't purchase anything. Like nothing can change, because when your debt to income changes, so does your qualification. So when if that 120 days is up, or if the lender chooses to pull credit right before closing, then you could lose your qualification based on the fact that maybe you went out and bought furniture right before closing, or you bought a new car, or you know what I mean, you did anything that would um, change your debt to income. You co-signed for your kids
So we
loan
so
again.
we monitor their credit the entire.
Okay.
Right, right.
Okay.
We're going to monitor any credit pulls and
Okay.
want documentation throughout the whole process. So once we pull credit, we we can see if another inquiry is pulled, and then we're going to say,
Right.
"Hey, you just saw this company pulls your credit. Did you buy something? Open something? What is this?" We have to address it. So
Right.
definitely, we're going to monitor throughout the whole process. And like you said, if you're going to change that to income ratio, you could change your qualifying.
Absolutely. And it's important that people understand that, these banks are loaning you hundreds of thousands of dollars. So you might go, oh, it's a mortgage, it's the house is collateral. It's still hundreds of thousands of dollars. And they're going to make sure that you have certain requirements. The homeowner's insurance has to be in place. The title has to be clear. The information that you're providing has to be correct. You have to show up. You have to sign the documents. We ran into a situation. I heard of a situation. Thank God it wasn't me, but one of my title officers ran into a situation where a gentleman had went in $100,000 higher than he thought he should because he wanted to win the deal. So when it came time for him to go to closing, and you're going to get a kick out of this, but when it went time for him to go to closing, he didn't want to go because the appraisal came back at value, and he couldn't believe that it appraised. And so he was like, no, this should not have appraised. This should have been $100,000 less, and I'm not going to pay this much for the house. Well, sorry, dude, it appraised, right? I mean, at the bottom line, at the end of the day, we all have
Right.
to
Yeah.
remember.
Whatever you've
Yeah.
agreed to
Can you
certain terms of
imagine?
the
Like,
loan and the contract and whatever.
so then lawyers got involved, and he showed up and
That's
bought the
insane.
house, and he was livid. But you can't trick, you know what I mean? Like, don't try to be a trickster, because in this market, things will appraise. Things can happen. You're counting on one appraiser to go out there and say, hey, you know what? I'm going to give it value. They only need 3 sales that are within a certain range to give you that value. And so if you think you're slick and you think you're going to come in and offer more and then base your trust on the appraisal, learn from this person, not from yourself. It's not a good idea to do that. What is the biggest mistake people make with their lender when purchasing a home? And this was an out of state question. So, everybody listening, this is a general response.
I mean, the only mistakes that I can think of as far as somebody making the mistake is not sharing all of the information that's pertinent to the process. And as we
Right.
discussed earlier, whether they've co-signed a car for somebody, whether
Right.
they've changed jobs, or maybe didn't tell us that they were paid commission versus salary, or partially of each, commission plus salary type of thing, or when we told them we need to document a 2-year history and we need to show the same line of work, same type of pay. They weren't really honest with us about the previous job and what that looks like now,
Yeah.
because we do have to show that they have the ability to repay the mortgage. And that's what it comes down to, and that they've shown that they could pay their bills over time. So
Yeah.
you have to show a history of being able to pay, and to predict going forward you'll be able to pay as well. So you have to
Absolutely.
be really honest with your loan officer of your complete situation.
100%. I
Like you
think
said, any
that
tricks they're going to.
right, you're not going to outsmart the people. You're not going to outsmart your lender. You're not going to be able to have money under your bed because it's not seasoned. And I think one of the things that people do sometimes is they stash money under the mattress or in a safe or wherever because of an emergency or whatever. I had a situation where one of my buyers said, "No, I have the money. I have it at home." And I'm like, "What do you mean you have it at home?" She had $13,000 at home that she was trying to use for her down payment. You can't show up with cash. The lender needs to know where that money came from. Was it earned? Was it saved? Like, was it a gift from somebody? All of that has to be expressed. So deposits are as important as withdrawals because the bank needs to see your whole story. They don't want pieces of it. You got to go in strong, and you got to say, "Hey, look, I'm depositing this $13,000 that was under my mattress now." And that lender might say, "Well, it's going to have to be 60 days from now that you can use that," right? I mean, is it 60 days that it has to season generally?
So the issue is there's rules and regulations nowadays about money laundering. So if somebody shows up with a bunch of cash, how are we supposed to prove where it came from? Maybe
Right.
maybe it's legitimate, saved over time. Maybe it is somebody who's money laundering. We just don't know, so we can't use it. If
Yeah.
it's been sitting in your account for a certain amount of time, it's assumed that it's your money. If we go back and track the bank statements that it's been in your account, then we assume it's your
Yeah.
money. But you pull it out of your mattress and try to stick it in the bank, and we're going to see that deposit, and we're going to say, okay, we have to verify where this money came from for that deposit. So you can't, like you said, you can't play tricks. Be upfront, be honest, and then we can figure it out together.
Yeah. I think that's the most important thing to answer that question. Um, and does it really matter what mortgage company you use? Because is it going to get sold anyway? Or, what matters when you're choosing a mortgage company? Should people be more focused on choosing one that they're going to stay with, or does it matter? It's very common that somebody,
So
I'm sorry,
getting
go
you
ahead.
to closing,
Yep.
getting you to closing using a local lender versus who's going to service your mortgage later are two different things. I mean, I guess some people think in their mind, I'm going to apply with this credit union because that's who I'm used to using. That's
Yeah.
who I bank with, but they don't necessarily specialize in mortgages, and they don't have the timeline to close on time for a mortgage. Let's say you write a 21 or 30-day contract and they can't close on time. Well, the seller doesn't have
Absolutely.
to extend your contract if they don't want to. So you have to work with a local lender who's going to get it done on time, that has trust in the community. That's the other part, because if you're the seller and you're looking at multiple offers, and your realtor as a seller knows that this particular agency doesn't close on time, or you can't reach them to ask them questions or get updates, you probably won't get your offer accepted when you're competing against 3 other offers that are local lenders that they can get a hold of on a Sunday night. So
Absolutely.
to get your offer accepted, to get under contract, you need to use the right company to do that. Even if maybe you're going to pay an eighth or a quarter point higher in rate, well, you're only paying it higher in rate because you got the house. If you didn't
Yep.
win the house, you're not paying
Yeah.
anything.
Isn't
You're
that
still
the
out there
truth?
searching. You're using the wrong company because you're using
Is
the internet union, right? So you have to look at it that way. That help me win the
Absolutely.
house. And it is what it is, right?
In real estate, we are always working. It's one of those things if you've heard or listened to any of our podcasts, we're constantly talking about how you have to team up. Even if you're not on a team, you have to team up. What if I need to have my gallbladder removed, right? How am I going to be there? I can't. So I have to have somebody in real estate that's going to step in and say, hey, look, Sue, I got you. We all have brokers, we all have managers, but we're all independent agents. And so lenders are the same way. They have a team of people that they work with, and they have managers or brokers or whatever, that somebody will step in and help them. When you're talking to a lender and you have an opportunity to maybe shop 2 or 3 lenders and you come back to that one lender, it's not always about the rate. Kevin's got a really good point there. You got to make sure that that relationship is strong, that that person's experience is there. We run into it all the time where a realtor, especially right now, buyer agents will say, oh, well, I'll do it for 1%. Well, okay, go ahead. You know what I mean? I'm not going to. That's not, I've earned my commission. And if you want to find a buyer's agent that's going to go out there, then, you got to make sure that they're worth their money. You got to make sure that you're in really good hands, because we are in an industry that is probably going to be the biggest investment you ever make. And money can be lost very quickly in these transactions. Some states have what's called earnest money deposits. Some states have what's called due diligence, where that due diligence money in North Carolina, we've talked about it before. If you're a North Carolina resident, when you buy a house, you are offering a due diligence fee that seller gets to go to the bank and cash day one. They are accepting your offer because you've given them a due diligence fee. Now, that due diligence may be much less than the earnest money deposit, because you cannot get it back. You're saying, hey, look, I'm going to do my inspections, I'm going to do this, I'm going to do that. But keep in mind, in some states like Maryland and Pennsylvania, there is no due diligence fee. So that earnest money really matters. 1% is a good number, in my opinion. Some people will come in much higher than that. It really is based on what you and your realtor work out. But the lender has to be part of that as well, because that money also has to be seasoned. Everything that goes into the transaction is going to have to be seasoned, going to have to be disclosed on the document at the end of the day. We ran into a situation, Kevin, where somebody needed some closing assistance, and the realtor was going to donate to that closing assistance. Or I'm sorry, I guess it was the family member was going to donate to make the difference. In that situation, we did an extension because they had to go back to underwriting, because the money was not coming directly from the buyer. It was coming from a gift. So if you're at day